Where is it? There it is. There we go. How you doing, friends? Coach Ernie here, and this is the Zero DTE Final Hour Show. And today, we're going to do a continuation of what we talked about on Monday. And just so you know, do a little recap on Monday. In Monday's show, we were talking about gamma scalping. And today we're going to continue talking about gamma scalping and the progression that we go through our various campaigns. But on Monday, I selected a scalp, and hopefully those of you that were tuned in followed that scalp. Unfortunately, it was getting near the end of the hour, so I decided to stop the show. And wouldn't you know, right after I stopped the show, the scalp worked out and ended up making a lot of money. So that was that. And then also yesterday there was a similar gamma scalp setup, and that happened in a very similar way, in that it was late acting, but it finally did break, and that also made a lot of money for very little risk. Just so you know, the risks that we put on these trades are super tiny. So we're talking about maybe $50, $60, something like that. And yesterday's trade could have made as much as $1,400, $1,500. Monday's may not have been, well, actually it would have been. It could have been as high as $3,600. No, I'm sorry. That would have been my position size. So it would have been about $900. So imagine, you're putting on these trades and you're making 10x, in just about an hour's worth of work. And sometimes they turn out a lot faster than that. Most of the gamma scalps that I've put on have ended up working in about 15 minutes, but these past couple of them have taken some time. Now, I don't know if there will be a setup today. If there is, we'll take a look at it. But what I did want to talk about today was the gamma scalp trade and how we progress into some of our other strategy types. And let me first start off by talking about, what our strategies are. We are taking extreme risk, extreme asymmetric, not extreme risk, actually the exact opposite. Extreme asymmetric trades where we take very, very tiny risk for large potential outcome. And then, of course, we're going to manage the profit anywhere in the spectrum of results. We hope that we get that maximum profit because they can have spectacular payoffs. Many of them as much as 20, 30 times the risk that you take. But, the thing that's more often is when we get about a 5 to a 15 times return, which still is just, incredible. And what's great about it is that because you're taking on such small risk, that you can trade these all the time, every day, and even if you have many losers in a row, your drawdown is just a slow bleed. So you're never really impacting your account. And then when you make big money, you're advancing. So small losses, big wins. Small losses, big wins, and sometimes gargantuan wins. But always a small loss. And that's the hallmark of all of our zero DTE strategies, particularly our most basic one. Now, let me explain the lineup of zero DTE strategies. They go by how much time we spend in the market, and each one is determined by various market conditions, or we call them campaigns too. So we have the zero DTE trade. And the zero DTE trade is exactly how it sounds. It's a day trade. We play it on the very last day of expiration, typically with the indexes like the SPX or the NDX. You could even trade it with gold or or crude oil futures as well, because they also have 5 days of expiries a week. But indexes are typically what we do. And by the way, there are also micro versions of the SPX like the XSP. And we also trade the index futures like the ES or the NQ for the NASDAQ. So we have a wide range of things that we can trade every single day. And all of them put on very, very low risk and large potential gain. For 0 DTE, what we're trying to do is capture both directionality and premium decay. For all the other trades that are longer dated, they're also an element of directionality and premium decay. We don't put on, or very rarely do we ever put on, a at-the-money trade because the risk is just way too high. And the gamma is going to be way too high. So, for instance, we're not going to be doing the iron condors that you're probably used to, which do have a long-term negative expectancy. That means that if you do the iron condor as the way most people do it on a regular basis, you will eventually lose money. And that is because of the extreme gamma risk and the large risk that you have to take for a very tiny profit. So we just don't do that. We go the other, we flip the script. So that's our 0 DTE trade. Then there are longer term trades. We go from 0 DTE to 1 to 3 DTE, 3 to 5, 5 to 10, and then much longer ones that are typically used mostly for portfolio insurance. But our main trades are 0 to 15 or 0 to 10 days. And that gives us about 3 or 4 different campaigns for various different types of conditions, setting up for economic reports, Fed announcements, or all kinds of conditions. Super low volatility, super high volatility. Each one has its place. The trade that we're going to talk about today is kind of like the next step going on from a gamma scalp. Now, gamma scalp is a kind of 0 DTE trade. So let me just talk about the 2 different types of 0 DTE trades. Gamma scalp being one of them that we take at the end of the day. And the reason why we take it at the end of the day is because gamma has built up tremendously after there's been a lot of premium decay throughout the day. That's why it's called a gamma scalp. We wait for gamma to build up so that price sensitivity is super high. And we're waiting for a move into our position. We can get nice and close, and then a very small move will result in an explosive, excuse me, need some water. A very small move can result in an explosive profit return. And then there's the morning trade, which is usually only in it for about an hour, 2 hours, but it can go all the way throughout the day if everything works out well. A quick move will result in anywhere from a 25 to 250% return. One that might take a couple of hours might turn into as much as a 400, 500% return. And if it hangs on throughout the day, you could easily see 1,000% return or more. So that's our basic 0 DTE trade. But it's typically taken in the morning when volatility is at its highest. So we have the 0 DTE, we call it the classic trade. And then we have another 0 DTE trade that we call gamma scalp. That's taken at the end of the day when gamma has built up. And then the next trade we'll be talking about today is the gamma door trade. And the gamma door is defined by the amount of time that you're in the trade, from 1 day to 3 days. And with the gamma door trade, we're really looking for structural levels in the market being violated. And so we're also looking at gamma and the gamma exposure, or the GEX. Now, you may or may not be familiar with that, but gamma is something that you can easily compute right in your spreadsheet. You could download the options chain from your platform. Most platforms allow you to download the options chain, put it in your spreadsheet, and then plot the gamma exposure histogram, and that will show you where the gamma walls are. Now, the interesting thing is those gamma walls typically align with volume profile. So that's another thing that comes into play here. We have volume profile and gamma working in our favor here, and we're trying to find places where the market looks like it's going to flip, either flip to the upside or flip to the downside. And you can think of a gamma wall, and even where they are usually located right on a structural level that you can see very clearly with volume profile, as being kind of a toggle, and it's one of those toggles that either goes quickly this way or quickly that way, depending on which way the market is leaning. And when that happens, that's when you get these quick moves. And so we're waiting for that. So what we'll do is we'll put on a trade that will be 1, 2, or 3 days out, position it around a gamma wall, or waiting for a gamma wall or a gamma flip to occur, and then positioning it maybe across a low liquidity area into a target area, what we might call a volume shelf. So what we're doing is a lot of analysis of the market and volume profile, figuring out where the gamma walls are, positioning ourselves either above or below it, and then waiting for that eventuality to happen over 1, 2, or 3 days. We don't know when it's going to happen, so we put our trade out there with, again, super low risk. We're typically looking for something called the convexity level. The convexity level is where the cost of the trade changes dramatically from relatively high cost to super low cost in just a couple of strikes. When we find that level, that's where we place the trade, because that's the place where most other traders aren't willing to go. Now we are, because we know that that's the trade that's going to pay off. Those are the trades that end up exceeding the expected move and then fall into our position. And so by playing it there, we're paying a little money for a huge payoff. And we're giving it plenty of time to work its way out. So if we play both sides of the market, that gives us the time to wait for that event, that gamma flip to occur. Now, we don't know if it's going to happen. There's a good chance that it will happen, but we still don't know. So we're not really predicting. What we're doing is we're positioning for that potential move. And because we don't know, and quite frankly, I don't know who knows where the market's going to go on any day-to-day or multi-day basis, we don't try to predict. We position, and we take those trades with extremely low risk and then wait for them to pay off. And we can layer these trades on day after day after day. And they get hit with pretty good regularity. And when they pay huge. And when they don't, they lose extremely small. That's the recurring theme in everything that we do. All right, so before I go on, let's see here. It looks like we have some comments. Am I the only one who can't hear him? Audio clear here. Audio good here. All right. Yeah, the microphone is right here, right there. You probably heard that, right? Coach, here's a question. Coach, is it important that the convexity point intersect with the gamma wall location price? No. As a matter of fact, they're typically nowhere near it. You can think of the gamma wall as the thing that's going to get price to move. It is the catalyst, right? So the gamma wall builds up. There's a certain strike area or a certain price level, and it contains a great deal of affinity to price. Price is attracted to it. And then price wants to be in that area. It's usually, about the size of a strike, about 5 points. It wants to be in there. But when it gets on one side or the other, it's getting drawn to maybe another gamma wall or another feature, or maybe the market has just decided to move on from there because it no longer finds value there. It found value there for a bit, and now it's out in the open, and it's saying, I see greener pastures over there. So it heads there. And then once it does, it's typically going into an area of low liquidity, because the gamma wall is typically an area of high liquidity. And so it leaves there, and it's looking for the next target or the next area of value. And it will often do that in kind of an abrupt move, as you saw on Monday. And if you were watching that trade, all of a sudden, right after I exited the show, it went, just dropped. And I'll show you that. We should go there now so that you can see that. Let's see what happens when I press this button. Ah, good. Well, so here's an example of a gamma wall being hit. Actually, it hasn't gone there yet, but it's actually, we'll see. So let's first go over Monday's trade. So this was, by the way, our trade. Let's see, was that? Oh, that's a way. Okay, sorry. That's Tuesday. So let me just define these. I usually have my my lines up to show where the morning session is, so then it's easy to see the day. But this is a trade that happened yesterday, where this area right in here is where the gamma wall is, and then it flipped up and then just kept on going. So we made really good money right up here. And then on Monday, a similar thing happened, but it was in the opposite direction. Here, let's put in the morning session so you can see for reference where it is. We were looking at this level right here, and I said that, man, when it crosses this line, it's going to, and gets over that area, it's going to find a gamma flip. This is right about here, about 325 or so, is when I stopped the show, and then a few minutes later it flipped, and then made big bucks. It was about a 10x return. So there's 2 trades, 2 days in a row. We had a similar one last week. Wasn't nearly as big. This was on Friday. Right, on Friday. Obviously, it didn't happen always near the end of the day. It happened right about here. The gamma wall at that time was positioned up around here. And then it flipped. It wasn't a huge one, right? But it still made really good money. The cool thing about this is that you can get relatively large butterflies very close to the market because you're near the end of the day. Prices are cheaper. And gamma is much more sensitive because that premium decay has already occurred and it's filling up the profit tent. So your price, when it heads towards your butterfly, because you're so close, it doesn't have to move more than a few points, and you go from like $0 to hundreds of dollars in just a matter of seconds. I don't know if there was one on Wednesday. I don't recall, or Thursday. I don't recall taking that trade. Yeah, there wasn't one there. But you can see they happen quite often, and they usually happen in low volatility environments. If we look over here, we can see that volatility is very low at under 15, 14.92. And we call that zombie land, as you can see over here in the lower right. I've marked out the various volatility regimes: zombie land, the Goldilocks zone, and chaos. Actually, I prefer chaos over Zombieland because there's way more opportunity. But Zombieland has its own opportunities, like the gamma scalp or the gamma zone trade, where we're looking for that kind of gamma optionality. All right. When I show the VIX like this, what you're looking at is our playbook of all these different trades that we take. And as you can see, it's largely dependent upon the level of the VIX. All right, so let's get on to here, where we showed you some of these trades. I don't know if there will be one today. the as far as I know, the hinge, or what we call the gamma door hinge, is actually way down here. But where is the highest level of gamma? I have not yet checked, but let me see if I've plotted some of it right here. So we can see that this wall here at 6485 on the SPX, which would be about that would be about 6500 on the ES, because there's a 15-point differential right now, a 15-point premium on the ES. 6485 would be I said about 6500, right? 6500 is way up here. That's where that tallest bar is. But that's where the current gamma wall is, and you can see it kind of flipped off of that. But the crossover, when the positive gamma goes to negative gamma, that's what we're looking for. That's what we would call the hinge. So I don't think there's going to be a trade like this today. There's no clear place where we would place that. We're typically looking to place it on the edge of one of these gamma walls, because it will then tumble and then go through the hinge. This is what we call the hinge right here, where it goes from positive to negative. All right. And flip over there, and then that accelerates the move. Now this guy here is at 6475, which is right where this yellow line is. So had the market been way down here, I don't think it's going to get down there right now, because there's too much affinity for price right now up here. That's where I expect it to stay. But if it did get down here, we would be looking for a flip, maybe over here. But it's right now, it's just going to be chop in this area. And that's not the best situation for a gamma scalp. Chop, you might be able to scalp, but it's not going to give you a clean and objective entry exit. All right. So let's go back to here. We have some more questions. Hey, coach, had a gamma trade on yesterday, took the trade off for a nice profit. If I had left it for longer, I would have had a 100x trade. Wow. Was still happy with the trade, though. Yeah. Yeah, so I was in the same situation. I got out a little bit early and only made about a 12 times profit, which is still good, right? But 100x, that's crazy. Thanks for that, Daz. And I guess Frankie is saying yes. Okay, what does Frankie have to say? Coach, is there any more significance to gamma walls on lower time frame as opposed to bigger time frames, especially for gamma scalp trades? Well, the bigger time frames, now you're looking at averaging out gamma and looking at it over a longer time frame and normalizing the gamma curve. That would be used more for the gamma door trade, which is the longer time frame from 1 to 3 days. Now, I'm not prepared yet to show you that, but that's why I wanted to introduce it to you. This is the transition from gamma scalp to gamma door. Friday, we'll get into it maybe a little bit more detail, or we might just look for a gamma scalp trade on Friday. Man, wouldn't it be cool if we could, during this... See, this is the thing. I'm doing this show at the prime time when these gamma scalp trades are coming on, and especially when there's low volatility. So as long as there's low volatility, I'll be focusing the show on seeing if we can take one of those gamma scalps. Today doesn't look like one of those days, even though the volatility is in the right place. Positionally, we're not in the right place. Okay, thank you for that correction, Daz. 10x. I've never seen a 100x trade. I have seen 60, 50, 60, 70 times trades. Those have happened. And that's because that's really all dependent upon the risk to reward that you're getting into on a trade. And most of our trades, I mean, it is possible to get that 100 times, but that would require that you get the cheapest trade and then pin it perfectly, right? So for example, a 50 wide trade, 50, that you paid 50 cents for, so that would be minus 0.5, would have a profit potential of $4,950. That would mean that you would have to pin that trade right at the center strikes, and that is such a hard thing to do. It doesn't happen very often. It's only happened to me a few times in my career. I've gotten a lot of trades within a few points of it, and those are exceptionally unbelievable trades, but not right on. My closest trade was within 3 cents of the center strikes. And for a trade like this, yes, it can pay off very nearly 100 times, but it'd be closer to about 95 to 99%, 99 times. What's more apt to happen is that you're off by 10 or 15 or 20 points, but you're very close to the center, but you're deep inside of the profit tent. And those can often turn into 50, 60, 70x trades. I know this sounds crazy, but this is the type of trading that we do, right? This is really a pro-level strategy. It's the kind of strategy that you'll see institutional traders do. Virtually all traders that are trading at a pro level are looking for the smallest possible risk for the largest possible return. That's going to control your drawdowns and keep your volatility of returns very low and your Sharpe ratio high and consistent returns over the long time. Now, it may also mean you go sideways for a bit, and that's okay, as long as you don't go down. Because as long as you're not going down and going sideways or up, you are compounding. So that's the key. All right, so we got Nitty. There seems to be a level at 64.97, so would you look at that to take a gamma scalp? Well, 64.97, are we talking about the ES or the SPX? So I need to know that so I can take a look at what you're looking at. If you're talking about the SPX, then I'm going to have to do another download of the options chain data, and that takes a few seconds. So let me know, Nitty, if that's the ES or not. If you're trying to refer to just a volume profile feature, I would say that while it is a good chance that there is a gamma wall near a volume profile feature, in fact, they almost exclusively line up. Yeah, he says the ES, so that's on the futures. There is almost exclusively that is the case, where these gamma walls line up with the edges of nodes or the deep crevices in a node. So let's do a little study of that. And we can go out to a bigger time frame. We'll go out to about an hour, maybe 2 hours, and we'll check out where these nodes are. All right. So this is at the top of the market. We don't really need to go much further than that. And you're claiming 94. Let's see, what was the claim? 94.97. All right, so this is the ES. And 94.97 is way up here. Well, that's almost exactly where I have this guy here. And in fact, that's where I placed where I identified where the first node was, the gamma wall. Let me show you. So this here is, well, you said on the ES. There is another gamma wall out here, but it's substantially lower than these guys. This is really the big kahuna right here at 64.85. Now price may not be right around there at this time. Where is price? So price right now is up here. So there is a minor gamma wall there. It's not the biggest one, but we could find ourselves on the all-time high side of that wall. And if we do break through an all-time high, we could find ourselves popping up and maybe then getting beaten down. If we take a look at so here we are. If we take a look at the delta variant of volume profile, you'll see that the delta variant is showing extreme pressure at these all-time highs from sellers. That's what the yellow is. So they're coming in pretty strong there. The delta, when you see yellow or brown over blue, that means predominant seller activity. If you see blue over yellow, then that's predominant buyer activity. So now we're down to here. So when we did get up here, right around that area that we were showing, it pushed it down. Now, what does that mean? Is it going to get pushed all the way down? The 85 area is where there is another wall right here, a bigger wall. As you can see, it's kind of lining up with this consolidation. Here, let me show you on the right here, this guy here. See, it's at 64.85, big wall. So we came up here because there was some price affinity, and then it got rejected down to here. So now the question is, can it move down another 10 points or so beyond 64.75 and then find and fall off the cliff, right? That's what we would call the gamma cliff. Yeah, this is a minor, that's like a gamma ledge, and then this is the cliff. And then you roll down the hill. And then you get to the gamma door hinge, and you could continue. That could end up being a nice sharp move, but that's what we have to contend with. So while you were right that 64.97, which was really aligned with this gamma wall here, but a minor wall, and now price has made it back down into this cluster here. So I expect it to hang out there for a while. All right. Now, I mean, if you want to know how to create these charts and do this type of analysis, then I would recommend that you go to our Fat Tail community. Hold on. Got to put on the big head here. There we go. So we teach all about zero DTE trading, optionality, convexity, these gamma scalping, the zero DTE trades, the Batman, the time warp, the convexity stack, the sigma drift, all the different time frames, how to do proper risk management and portfolio management, how to create your proper routine, everything that you need to develop yourself as a trader. And you can get that link right down below here in the description. That's our Fat Tail community on School. And so there's courseware there, probably, I don't know, 20, 30 hours of course videos, as well as tools, resources, and a community where you can be talking with like-minded traders that are all there for one purpose, and that's to learn how to become a pro trader. Now, I'm also there. I answer every question that's asked of me inside the community, and I provide 2 coaching calls every week. I'll be doing one on this Friday and then again on Monday. So that's the place where you want to be if you want to learn how to do this stuff. Learn how to control your risk and go for those outsized profits. All right? This is like the best way to take a small account and blow it up, because you're taking such small risk. You can easily afford to get into a small trade that could potentially make huge gains. You can't do that with these momentum traders. You have to build it up slowly and slowly. this one, this type of strategy, yeah, you might be going sideways for a little bit, but that's sideways. That's not down. And then when you do hit a big trade, you could literally take a small account and double it, triple it. That's not hyperbole. That is actually, that's what can happen. So this course or this community, I think, is exactly what you need if you want to step your trading game up, learn how to be a wealth manager, and focus now on profit management than risk management. That's because the risk is all built in to the trade itself. It's defined. All right. Let's go on to... we got another question. Daz says, I was previously concentrating on high win rate credit spreads. Was going great till I had the first loss, wiped out all my previous gains and then some. Well, that's the problem. High win rate. Let me just be very, very clear. High win rate is what is sold to all retail traders because it sounds like it makes sense. It's kind of an intuitively the good thing to do, right? But that's why they're trying to sell it to you. They sell you on that, thinking that, he's going to come in here and he's going to take this stuff. We'll try to convince him that this is the way to go. But how many people do you know that actually make a winning off of high win rate? Very, very, very few. In fact, virtually nobody, because it's almost impossible. It's an impossible strategy to scale. That's because you have to take huge risk to take tiny little profits. That's how they get the high win rate, by taking these tiny, tiny little profits. But you're always taking this huge risk, and that's exactly what, Daz, that you experienced. One loss wipes out a week, 2 weeks, 3 weeks of trades. And there's nothing that says that you can't have 2 or 3 of those losses in a row, which basically wipes out an account. If you flip the script and go our way, yes, you'll be trading at a lower win rate, typically around 50%, but you won't be going down. You'll be going sideways or up. And instead of managing risk all the time, you'll be managing profit. Completely different situation. Plus, this type of strategy has long-term positive expectancy. In other words, if you trade this long enough and follow the strategy, you will make money. Where the other strategy, you end up losing money. It's the reason why 90+% of all traders lose money, because they follow this sort of retail hell strategy. The strategy that I'm showing you is what pro traders use. They use it for a reason, because it keeps them out of the brink. It allows them to keep their sanity, sleep at night. It allows them to make good, logical, rational decisions because they're not under pressure. That is the key to this type of strategy. Small risk, large potential return. All right. So we got another question. Midnight Blue, how you doing? What would be the minimum account size that you would suggest before going your group? That's a good question. So I did a study where I determined how small that you could go before you start experiencing a risk of ruin. All right, let me see if I can find that. I know I have it in here somewhere. Just give me a second. I'll find it. Yeah. I have it in a Python file, and I think I would have to. Yeah, I don't know where it is. Well, anyways, I do have a little bit of a chart here that shows what to expect. Let's see if I can bring that on. So the question is, what would be the minimum account size that you would suggest before going to the group or to trade this strategy? And it can be very small, by the way. And this, the answer to this here it is. So this is a study I did a long time ago, the risk of ruin probability. And this is actually for a different strategy. This is for the zero DTE strategy. And it says that you can start with a $2,000 account and have about a 30 to 35% chance that you will bust the account, right? Because of the nature of the zero DTE trades, we're taking slightly bigger risk for the amount of reward. But the type of trades that I'm talking about, this would be the case for as little as a $1,000 account. And you can shift all this up. So I wish I could find that. I did a Monte Carlo test to show exactly where that comes in. And maybe I can find it. Let's see. Test. Oh, cannonball risk of ruin. Let's see if I can recreate it here. That'd be cool. I'm going to create a new Python. This is the code that I wrote a while ago, so we'll see if this works. And we'll call this risk of ruin. Here's the code. It should run. Nah, of course not. But anyways, it doesn't run. It's because why? It's interesting. Particularly partially initialized module pandas has no attribute read CSV, most likely due to a circular import. Yeah, it's gonna. I can't find the actual code, but let me just tell you the results. We found that once you get beyond a $4,000 account, your risk of ruin goes down to something in the 0.05 or less percentile. When you get up to about a 2,000, it's closer to about double digits, around 12, 13%, something like that. You get to 1,000, then it gets a little higher, about 20%. And then to 500, I think it's around a 35% risk of ruin. So you can have fairly small accounts, and if you want to, try your luck with really tiny, and then see if you can make a couple of big trades, and then now you're into an area where the chance of ruin is extremely small. Or you can just start off with an account that already gives you enough leeway to hold you over. So I don't know. I might have it in this other. Here, let me go back to the big head here. Let's see if I can find it somewhere else. No. So This is an example of one of the Monte Carlo tests that I did here. Not that. That looks at the number of times a strategy would win versus lose. And as you can see, this is run 10,000 times for one of our campaigns called the Sigma Drift campaign. And the amount that, all of these, this campaign started with, let's see, there's a configuration here, starts with $5,000. All right. So that campaign is showing, starting with $5,000, approximately 94% of the time you're going to win. And then this small percentage of the time you're going to lose. So this is the campaign run 10,000 times. And the vast majority of those wins are going to be in the 20, the big one, from about 50% to about 120%, with wins as big as 650%. But that's way out here. Those are outliers. So you can see that running these types of campaigns are a good bet. You will often be moving sideways, as shown here, but typically up. Oh, I see. This isn't actually simulating my Sigma Drift. This is simulating the 0 DTE trade. So, yeah. Well, anyways, hopefully that answers your question. All right, let's see if there are any more questions. There's one other. Which backtest platform do you use? I've probably one of the premier experts on backtesting, but there is no backtesting in this type of strategy. I mean, I can show you in a Monte Carlo simulation what are the probabilities that you're going to have a successful campaign. But the backtesting is predicated on so many different things. First of all, it's assuming that you know exactly where you're going to enter or exit, and you don't. These are all options trades that are run by humans with discretionary choice, so a backtest is going to be meaningless, really. These Monte Carlo simulations aren't even based on that, and they still add a fudge factor into them. They're all based on whether with hands off. But if you get your hands involved in a strategy, it's going to give you different results. Your slippage is going to be different than what was predicted by the computational model. The commissions are often not put in there. You're testing things that happened in the past, not what's going to happen in the future. You can do forward walking of these tests, but even there, they have limited viability. So I'm not a big proponent of backtesting, even though I've spent a good portion of my algorithmic quantitative life doing backtests. So I do not use any backtesting platform. I don't have to. The proof is in what happens here. All right. So that's about it. Let me just remind you that if you want to learn more about this strategy, go join our Fat Tail community on School. The link is right down below. It's a unbelievable low-risk way to find out how you can become a pro trader or trade like a pro. That's about all I have to say. On Friday, we will see if there's a gamma scalp. Let me just check, just last check, right? Just to see where we're at. Yeah, we might be breaking new highs. We're banging on the door. So I don't believe that there's going to be any gamma scalp today. Yeah, that's it. All right. Thank you all very much. You've all been great. Have a good one. Take care. Coach Ernie out. Yeah, I forgot. Give this video a thumbs up if you thought you got value out of it. Thank you very much.